Hello viewers, this is Akshat Garg, Manager Research Choicewell. Welcome to another session with the Fund Manager, where we bring you the market scenario and recent trends in the mutual fund industry. Today, we have a very special guest with us, Mr. Harish Bihani, an IBS alumnus who has 15 years of industry experience, currently managing ICICI Pru Small Cap. Prior to joining ICICI Mutual Fund, he has worked with SBI Mutual Fund and Kotak Institutional Equities. Welcome, Mr. Bihani.
Thanks so much, Akshat. Thanks for inviting us.
Yeah, welcome. Okay, so recently state election have been concluded, and as par with our expectations, we can see consecutive hikes in fuel prices and gas cylinders, which may again push inflation from its upper band of 6%, which is set by the MPC. What impact can it cause on the economy, and is it a right time that RBI must switch its accommodative stance?
Sure. So, first, before looking at the Indian inflationary scenario, let's kind of look at the global inflationary scenario. How is it shaping up? Globally, in the last 1.5 years, seen sharp spike in various commodities, energy prices. We've seen sharp spike in US inflation. It's been led by higher consumption of goods versus services. And clearly, it's a inflation is a global concern. We think that central bankers globally have taken cognizance of sharp rise in inflation. They are looking to control the inflationary expectations over the next 6 months to a year or so. And in that context, we will start seeing similar measures coming in India too. In India, for example, we think that inflation will rise to about 6% in fiscal 23. And clearly, this is above the RBI comfort zone. In that context, and we all understand what's happening to various commodities in India and globally. And in that context, we think that RBI will take cognizance of rising inflation. Like global central bankers, they will also try and control the inflationary expectation, which is extremely important in terms of the balance between growth and inflation that every economy would like to have. And we'll clearly kind of start seeing actions over there, maybe very, very soon in the recent monetary meetings of RBI. As you would see rising prices all across, and with that rising inflation and there would be a scenario of rising commodity prices, rising inflation, rising interest rates, and that clearly will have impact on certain consumption sectors, certain other sectors, and we'll certainly see some impact of on the final demand over the next couple of months and quarters. So clearly, should be an impact on the demand impulse from rising inflation. We'll see more of that in the coming quarters. We as portfolio managers have taken cognizance of this rise in inflation globally and in India. We have taken impact on the earnings of our companies. We are kind of closely watching this particular scenario. We clearly understand that in the context of what is happening globally, will clearly see a significantly higher volatile markets versus what we would ideally like to have. So we are well prepared in terms of thinking about individual portfolio companies, portfolio size, so as to ensure that we kind of protect our investors' money on the downside and try and participate on the upside over the next 3 to 5 years.
Okay, so you must be expecting rate hikes in the future by RBI in the coming MPC.
I think more from a very their stance was kind of more. They were clearly in terms of moving. They'll slowly and steadily start moving to more neutral stance,
Right.
and we'll start seeing that rate hike cycle coming through. Maybe if not in the recent meeting, maybe in the meetings that will happen after a couple of quarters, we clearly start seeing rise in interest rates. A rate hike should start to happen fairly soon.
Okay, since we talked about prices, I want to talk specifically about the crude oil prices. Well, India imports 85% of its oil needs, and as a nation, we are at the third rank in the consumption as well as in imports, which clearly shows our vulnerable plethoric dependence. I've seen ministers and activists talking about alternatives like biofuel, electricity, hydrogen. I would like to understand how pragmatic is to mutate to one of these energies as a long-lasting solution without hurting the existing numbers and quality.
I think you're correct, and this has happened especially with regard to the entire concerns with regard to fossil fuels, the impact it has on the environment, and the ESG activism, which started several years back, but it's picked pace, especially in the last couple of years. We had seen that both local and global investors had started taking cognizance of some of these issues, which obviously has an impact on final investment in some of these areas, like say energy area, oil, other commodities, etc. Nonetheless, the impact which especially developed markets have seen over the last 1.5 years in terms of energy shortages, power shortages in certain parts of European region, even in US, there are certain parts which are seeing shortages in terms of energy, etc. Developed countries have taken cognizance of these particular issues. There's clearly a need to balance between the long-term goal of ensuring that we use lesser fossil fuel, there's lesser emission, lesser carbon dioxide emission, versus kind of ensuring that we have
Mhm.
more stability on energy prices, we have enough commodity to ensure that we kind of balance it out between the near and medium term versus the longer term. So in that context, I think global uh, global leaders have taken cognizance of this particular issue, and we have already started seeing a higher capex announcement by various countries and companies, which should ensure that we have a little balanced future. We'll have to keep moving towards having more renewable energy, renewable fuels, and others over the long term, but we'll need to maintain a balance in the near to medium term. I think that's the way to approach this particular
Right.
issue, and
Right.
we'll see more and more of that in the coming years.
Okay. Speaking globally, the US yield curve has started flattening, which is definitely not a good sign. As history has given testimony quite a time, as US Treasury yield curve has inverted before each recession since 1955. And the last time it inverted in 2019, and after that we saw markets crashing worldwide. What's your take on the same? Are we going to see any repeat here?
Again, you're right that the 10 to yield curve is what how we kind of define it. That has started inverting, and that has been a sign of recession. That has given a good signal on recession over the last several decades, and we'll need to certainly keep that in mind as we approach the economy and the markets over the next couple of quarters and years. Why is that important? Is because this particular signal is reflexive. What does that reflexive or reflexivity means is that the indicator itself creates an impact on the fundamental that it is supposed to reflect, which
Mm-hmm.
means that as market starts looking at these particular yield curves kind of inverting, it
Mm-hmm.
start thinking about recessionary pressures coming through, and we move into a vicious cycle as market participants start looking at the overall yield curve indicating a recession. So it's reflexive in nature. And so we'll clearly need to kind of take that into cognizance as we approach economy and the markets. I think as investors, we are clearly doing that at this point in time. We are keeping a close watch on various indicators, including these yield indicators. And in that context, I think that the market could be a little more volatile versus what it has been over the past couple of years, especially with regard to how the global inflation environment, as we discussed, is kind of shaping up. We are seeing no kind of let down on the inflationary pressures. Central bankers will keep kind of taking actions even higher over the next couple of quarters on the inflationary front. They will try and bring the inflationary expectation down. And it's a very unique situation because a lot of the inflationary pressure is also coming from supply side issues, some of the transient issues like US consumers
Mm-hmm.
consuming more goods versus services, etc. Nonetheless, and the central bankers can control the demand impulse. So they will try and control the demand impulse. They won't be able to manage the supply side issues, including the entire commodity impact because of the Russian Ukraine crisis, etc.
Yeah.
But they will certainly start taking more action, which could kind of lead to this yield curve kind of approaching the level where market starts worrying about recession, and recession actually taking place over the next couple of years. So we have to keep a close watch at these particular indicators, accordingly kind of construct the portfolio so as to make it much more robust, anti-fragile, to withstand some of these issues which we'll approach over the next couple of quarters and years to come.
Right. Okay. So now let's focus on small caps. They started bleeding from mid of January in the last week of Feb and again rallying now. Investors have become more cautious with this much uncertainty prevailing. What's your outlook on the small caps and what should the correct approach to invest in them?
Sure. So in general, our approach is that we advise investors that timing the market is more important than timing the market. And in that context, when you approach a category like a small cap as a category, on average, will be very volatile during some of the market extremes, either on the economy or on the market side. And why is it volatile? It's volatile simply because of liquidity reasons. What happens is that during market extremes, especially when markets are correcting, the
Mm,
overall small cap company overall share trading could be significantly illiquid, and there could be a forced exit by a certain seller. He would like to forcefully exit on a
right.
certain position size, and that could kind of will lead to a sharp kind of volatility in the share price. Nonetheless, we think that volatility isn't risk,
Okay.
right? That has to be understood.
Right.
Volatility isn't
Yeah.
risk. Risk, according to our understanding, is a chance of permanent loss of capital.
Right.
And in that context, when you think about a portfolio construct of a small cap fund, any fund that you take, think about those companies. Those are real companies which are generating good amount of cash flows. They are growing in size. They have good return on capital, and so if and they have large. We are looking at companies which could become much larger in size and move towards becoming a mid cap or a large cap in the coming time. So in that context, when you have a portfolio of companies which will survive and thrive over the next 5 to 10 years, those are companies which will not shut down tomorrow or in the next 1 year or 2 year.
Right.
So the fund itself could be volatile, but volatility isn't risk. Risk is a chance of permanent loss of capital, and the chance of permanent loss of capital in a small cap fund is low. It could be volatile during market extreme, as we have already discussed. So our kind of sense is this, that anybody who's approaching a small cap category, given these kind of overall niceties which are there with this particular category, they should come with a time frame of at least 4 to 5 years. They should be able to withstand the volatility which is associated with this particular category. Think through long term, as you have seen in the past 3, 5, 10, 15 years. For the small cap funds which have been there for very long, they have been able to deliver decent performance in those time frames. Nonetheless, during certain extremes, they have been very volatile. So
Right.
keep that in mind, that as you approach this particular category, think about long term. Small companies, by its very nature, will become very big in size, or many companies will become big in size and graduate towards becoming mid and large cap companies. These are real companies with real cash flow, real earnings, etc. And as long as you have your long term framework in mind, you should do okay. Don't kind of think too much about volatility in the near term.
Okay, thanks. And now coming to the ICICI Pro Small Cap. So if we compare it to the industry average, I can see ICICI Pro Small Cap is overweight in the service sector. May you please share the rationale?
Okay, this is a good observation that you have, that we have higher location towards the services sector. Now, if you break that up, we are overweight on IT services, which is immune to whatever is happening globally, at least in the near term. Longer term, we can debate and we can there could be issues, but in the near term, it's immune to commodity hikes, etc. Then we have services sector. We have a lot of apparel retailers which are on the services side. Then we have a lot of open up trade, theaters and hotels, which are
Mhm.
benefiting from the open up trade at this point in time. So we have a mix of companies where we think that these are resilient companies which will survive and thrive over the next 3 to 5 years. They have tailwinds in the near term with regard to their earnings and cash flow. They'll be less impacted by the macro issues, either on the commodity side or on the other macro issues that we are facing at this point in time. And so, in that construct, we are very happy to have some of these companies in the portfolio at this point in time. As you would have seen, for example, some of these theater companies which are doing
Mhm.
phenomenally well at this point in time.
Right.
And they will be immune to all the global macro and global issues and the commodity price impact. Similarly, you have other companies like we have already discussed on the IT services. Secondly, in terms of the mode that we would kind of bring in for our fund, our mode is fairly simple, that we have a portfolio construction philosophy
Okay.
where we kind of divide the entire small cap universe into three buckets: bucket A,
Okay.
B, C, and we stick to bucket A and B companies and avoid bucket C companies.
Okay.
Bucket A and bucket B companies are essentially bucket A companies are essentially quality compounders.
Okay.
Bucket B companies, in short, are companies where there are near-term issues, which we call as P&L problem, but no balance sheet problem. So we think that if we have a portfolio of bucket A and bucket B companies, where our portfolio earnings is going to compound at, say, about a 15, 20, 25% CAGR over the next 3 to 5 years, then the overall portfolio outcome should follow. In the entire kind of philosophy, we also try and avoid bucket C, which are risky companies because of the construct. Either they have a balance sheet problem apart from a P&L problem, or they have management issues, or they will not be able to become much bigger in size, etc. So
Right.
we follow a disciplined approach towards bucket A and bucket B. We think about the entire construct with regard to how our companies will be able to deliver over the next 3 to 5 years, because that is what we are advising our investors, that look, when you're putting money in a small cap fund, think about the next 3 to 5 years. So when we are approaching our investment too, we are approaching in a very similar fashion, where we are saying that we look at our companies from a 3 to 5 year perspective,
Right.
and we
Right.
think about the earning growth and the exit multiples, etc. And we finally kind of think through of how the overall return should follow in the small cap category. So essentially, what the moat is very simple. It's a disciplined process which kind of ensures that the overall investor experience is decent in almost time frame that would have. We would try and protect the downside in a bad market and try and do well in an up market.
Okay. So how frequent do you take the tactical calls in your portfolio, like to generate the alpha for the investors?
Highly unlikely we'll take any tactical calls, especially in small cap companies. Small cap companies intrinsically are less liquid companies in terms of their overall traded volumes. So
Okay.
any tactical positions could hurt us. So we try and avoid taking tactical calls. Most of the companies that we would have are more structural calls that we would have. For sure, we'll have mistakes in some of the names that we thought are more structural but may not have worked out. We'll move out of those names. Nonetheless, the remaining portion of our fund would be more structural in nature. We
Okay.
keep thinking about the next 3 to 5 years across our portfolio companies,
Okay.
and we risk of the portfolio overall in terms of position size. So that we manage via the position sizing in terms of buying or selling, etc. So that is what we actively do. We don't kind of actively trade in and trade out of any positions from a tactical perspective.
Okay. So viewers, if you are long-term investors with at least 5 years horizon, you may continue your investment in small caps, more preferably with SIPs or STPs. It was a great session, Mr. Bihani, and I believe our viewers have learned a lot. Thank you for your time and speaking with us. We will be looking forward to many such sessions with ICICI Pro AMC.
Thanks, Akshay. Thanks for taking your time and inviting us for the show.
Sure.
Have a nice evening. Bye.
Thank you. Thank you.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.